Yesterday I said 11:30 when silver cracked, gold tracked but wasn't cracked, right? And then when it recovered, and my levels were uh, bearish below here, right? And then neutral in here, bearish below here, neutral in here, and bullish above it. And gold is an easier trade to do, right?
I think for buying, we're seeing for gold, and we're not talking gold stocks at the moment, just for gold is really the same drivers, the same buying, the same that we've seen for the last couple of years, frankly. I mean, it's still central banks buying, it's Chinese non-official buying, it's people concerned about the fiscal issues in the US. And it's also an increased awareness that the dollar is losing its status as the sole reserve currency.
Gold's break above $4,000 signals a new phase for precious metals, with Vince Lanci calling the move the start of a much larger rally. The move comes on the heels of Goldman Sachs' bullish forecast of $4,900 by 2026, driven by central bank accumulation, strong ETF inflows, and sticky investment demand. This combination of institutional and official sector support has effectively redefined gold's price foundation, setting the stage for a structural, rather than speculative, rally. Silver has also regained traction as investors increasingly rotate back into precious metals amid expectations of rate cuts and a softening dollar environment. At the same time, Lanci emphasized that short-term volatility in silver remains a function of technical positioning and market rumors. He pointed to unconfirmed reports of China potentially releasing additional metal into the market as a catalyst for silver's recent dip. From a tactical standpoint, he mapped clear levels for traders. Below $4,810 remains bearish, between $4,810 and $4,860 is neutral, and above $4,860 turns bullish with $4,875 as the key breakout zone. His approach prioritizes risk management over emotion, focusing on disciplined entries rather than reactionary trades. In contrast, gold's behavior has been notably more stable, recovering quickly from brief pullbacks and showing signs of leadership in the precious metals complex. Lanci described it as a cleaner trade, reflecting both its liquidity and structural strength. The alignment of institutional buying, geopolitical uncertainty, and technical momentum suggests that both metals are entering a new phase, one where price action is less about short-term noise and more about the long-term transition toward hard assets as financial anchors. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Gold, silver, softer, but did rally a bit yesterday on the whack in silver. We'll talk about that in a little bit. And grains are all up uniformly. When I say grains are up uniformly, what I mean is it's not crop related, it's not fundamental related, it's just funds buying, which means everyone is buying every commodity now. All right, let's go. Gold surged past $4,000 an ounce this morning, a day after Goldman Sachs lifted its price forecast to $4,900 by the end of 2026. The bank attributes the move to what it calls sticky inflows, steady buying from central banks and Western ETFs that now anchor gold's rally. Analysts Lena Thomas and Dan Stroivin say this structural demand has shifted the market's baseline higher, with risks still skewed to the upside. Silver followed suit, regaining momentum as investors rotated back into precious metals. Amid rate cut expectations, the shutdown does increase those chances, and continued official sector accumulation, not to mention the world's on the edge of a shitstorm. That continues in the premium post. Gold breaks 4,000 as Goldman raises the roof to almost 5,000. Put it that at 11:30 yesterday, the silver price cracked. And I said, okay, rumors of China coming back online and making metal available, which is still a valid rumor. And this is what I said then. I said, the market broke down from here. below, the market was trading right around here at that moment when I made that statement. And I said, below here, below this moment, below 48.10 is what I said, you're bearish. This is a short-term comment. Between 48.10 and 48.60, you're bearish neutral, right? Although it rallied in there, we don't care. Point is, we need to buy when it's safe, not when it's risky. Above here, which is where the whole thing started to leak, that's where you get bullish. And certainly they made it hard for you to get bullish. And there you have it. Sure enough, that's where we are now. Of course, this is the smart money saying, shit, it's going to go above there. I don't care. Let's go to gold. So there it is. Bullish above, meaning orderly, but that's an algo buying, by the way. Uh, uh, Bearish neutral, right? So it should have been bullish neutral, but who gives a shit? I wasn't trading it. And down here, bearish. So that's the way to look at it. You're not bearish on silver until it gets 48.60, at which point you become neutral. That's all I can say. That's a technical short-term comment. Wait, Trader Sumo, who's a friend of mine, we're mutuals. He's got a good product, Polytrends. Now, we tease each other a lot. He'll tell me his levels are great, and I'll say, well, they're probably the levels that I come up with a couple days later. And usually on his longer lines, they're pretty obvious. So I end up being right. Let's see what we have today. He doesn't agree with me today. How dare you? All right, so that's his 30-minute. So below 48.77. Oh, yeah, that's this line right here. Right. Yeah, I can see that. So he's basically taking my idea, or his system is, and he's saying you're long above 48.75. Okay, fine. So I will move my level, but not my behavior. Above 48.75, I'm outrageously bullish. On a test below 48.75, I want to see how it handles 48.60, and below 48.60, I'm neutral. Okay, so if it goes to 48.75 and dips below it, I will buy it coming back through 48.75 as long as it doesn't break this level. Let's go to gold. 30-minute, yesterday I said 11:30 when silver cracked, gold tracked but wasn't cracked, right? And then when it recovered, and my levels were bearish below here, right? And then neutral in here, bearish below here, neutral in here, and bullish above it. And gold is an easier trade to do, right? It cracked, it recovered faster, it lingered, and I got to be honest with you. See this here? I wasn't bullish until it got above here. See this here? That would have chopped me up if I was playing my get long above there and get stopped out. But I'm expressing things with options now, so the money that I've committed is already lost, one way or another. So here we are. Those are the markets. That's short term. All this stuff that we're talking about, it's to keep your brain occupied, it's to keep you focused, and it's to keep you grounded. The bigger picture is coming into focus for a lot of people that are your friends but aren't as literate in this stuff as you are.
Adrian Day explained that the current surge in gold demand stems from familiar, long-term forces, steady central bank accumulation, strong Chinese buying, and growing anxiety over U.S. fiscal stability. What's new is the recognition that the dollar's dominance as the world's sole reserve currency is eroding, prompting more countries and institutions to diversify into gold. This shift has even reached mainstream finance, with major firms and prominent investors projecting $5,000 gold and advocating substantial portfolio allocations. Yet, Day cautioned that such widespread bullishness could signal late-stage adoption when mainstream acceptance begins replacing early conviction. Despite gold's structural support, Day noted that many U.S. investors still view it through a short-term investment lens rather than as protection. On paper, the economic backdrop, firm growth, high rates, and tamed inflation don't fit the traditional triggers that draw them to gold. But beneath that surface, monetary realignment and geopolitical uncertainty are quietly reshaping the global order. By the time the average investor recognizes these undercurrents, the major move in gold may already be well underway. Let's get back to the interview.
Well, no, I think for buying we're seeing for gold, and we're not talking gold stocks at the moment, just for gold, is really the same drivers, the same buying, the same we've seen for the last couple of years, frankly. I mean, it's still central banks buying. It's Chinese non-official buying. It's people concerned about the fiscal issues in the US. And it's also an increased awareness that the dollar is losing its status as the sole reserve currency. And I emphasize that because, we've always talked in the past about, the dollar losing its status as the world's reserve currency. And frankly, in the past, it's always been, one or the other. It was the US since 1945. It was Britain before that. It was France before that. But, in this bipolar world that we're moving towards, there's no reason why you can't have more than one reserve currency that different countries, prefer or use. And I think that's where we're moving towards. But to the extent that the dollar loses its reserve status, to that extent, then obviously central banks want to reduce dollar exposure, which means buying something else. Well, we're seeing things like that from more and more of the establishment firms. I can't quote you. I hesitate to quote specifics because I don't have them at the top of my fingertips, but we've seen it from Bank of America. We've seen it from Morgan Stanley, as you say. Financial Times had a headline only a couple of weeks ago about, if Trump wins the battle with the Fed, it's gold 5,000. And remember, these are all, and then we've had a lot of sophisticated investors like Ray Dalio, of course, but others that have come out and suggested, 15% gold, 20% gold, 30% gold, 4,000 gold, 5,000 gold. And remember, these are people, not all of them, not Ray Dalio, but these are institutions that a year ago were poo-hooing gold. Remember, it wasn't so long ago that the Financial Times famously said gold is nothing but a pet rock and it'll never go up.
I remember that,
yeah. So, this, although it obviously it's nice to see Morgan Stanley tell clients they should have 20% in gold, and presumably that's going to get some additional buying into gold. But as a contrarian, I mean, we should, I think, be a little bit alert to this. I think these firms are tripping over themselves trying to sort of make them more outlandish predictions, or the more, well, not outlandish. $5,000 isn't outlandish, but to make these predictions, to outdo the other guy with how high allocation they should have. But there's definitely a fear of missing out. No question about that. And if you're I don't know how it went down on Morgan Stanley, but if you're, Morgan Stanley, and you've been trudging along for years now with no gold and everyone's perfectly happy, but now the RIAs and the financial planners and the brokers are beginning to get calls from clients. Hey guys, why don't you have any gold? Why don't you have any gold? And those people are beginning to tell their bosses, hey, our clients want some gold. That's a very significant, because it comes from the bottom up, not from the top down. In the US, people have never bought gold, or rarely have they bought gold as an insurance and a protection. They buy gold as an investment. When you're buying gold as an investment, the North American investor looks at the economic environment. He wants to see a slowing economy, low and lower interest rates, high and rising inflation, and a lower dollar. And other than the dollar, which obviously has had a big decline this year, but other than the dollar, the narrative is quite the opposite of what I've just mentioned. I think the narrative is missing out on a lot, but the narrative is that up until recently, we've had a strong economy, interest rates are still reasonably high, and everybody's saying they need to be lower.
Right.
The dollar, even though it's weak this year, it's still relatively high on a 3 or 4 year basis. And of course, inflation is, as everybody knows, under control and subdued. And so in that environment, that's facetious, by the way, and in that environment, the ordinary investor doesn't run to gold. And he certainly doesn't run to gold stocks when his S&P, his brokerage statement is going up every month. First of all, on a long-term fundamental basis, we are nowhere near the top of a precious metal cycle, nowhere near.
Wow.
And you can say that with all sorts of indicators. I mean, number one, valuations are still good, whether it's gold on a real basis or whether it's the valuations of the gold stocks, their price to cash flow, price to NAV. These are not high at all. And then anecdotal evidence. You know, at a market top, everyone is talking about the sector. You go get your coffee and the barista's got a gold stock tip for you.
Right.
Right? You go to a dinner party and everyone's talking about gold and the latest gold stocks they bought. Is that happening?
No.
No. But it was happening in 2006 with real estate. It was happening in 2001 with .coms. I remember getting into an Uber and the Uber driver wanted to tell me his 3 top .com stocks. Nothing against Uber drivers,
Right.
but that's a sign of a top. We're nowhere near that at the moment.
And it was with Bitcoin recently, 4 or 5 years ago.
Absolutely.
Yeah.
Yeah, absolutely. And in 2006, remember, everybody was talking about the latest house they bought with no money down.
Right.
We're nowhere near that, right? So we're not near a top at all. In fact, in my view, I'll say quite bluntly, in my view, we are much closer to the beginning of this bull cycle than we are to the end. Now, that doesn't mean we won't have a correction. And, you know, mid-cycle corrections in gold are quite typical. 1974, most of your listeners weren't around then, but I was. 1973 to 4, gold went from almost $200 an ounce to $100 an ounce. It was a 50% decline.
Wow.
And it panicked people and freaked them out, and people got out. And of course, then it went from $100 to $850. And you saw much the same thing in 2006. We forget, but it was a 35% decline in gold in like 3 months. In 2006. So mid-cycle corrections are much more in the stocks, of course. Mid-cycle corrections are quite normal. I'm not sure I see the sign of a meaningful pullback imminently, but by its nature, these things typically don't ring a bell, as they say.
Right.
You know, so could it happen? Yes, it could well happen. We've had, even though prices are low and the stocks are undervalued, we've obviously had very, very strong price moves. So that's one thing. We're also seeing the things we talked about earlier, Morgan Stanley and people, everybody jumping on the gold, all the big firms rushing to jump on the bandwagon. We're seeing a lot of capital raises. You've seen them, right?
Yeah.
And so all of these things, and then you look at the macro. I don't think that the US government closing added much to the gold price or silver price. But as often happens, if it reopens, that could be a trigger for a correction.
The steady accumulation of gold by central banks, rising global diversification away from the US dollar, and renewed institutional interest all point toward a deeper structural shift in the monetary landscape. As traditional confidence in fiat systems wanes, gold's role as a stabilizing asset is being redefined, suggesting that the current rally is not a fleeting trend but part of a broader realignment in global wealth preservation. Could the growing institutional and central bank demand for gold mark the early stages of a long-term shift away from dollar-based financial dominance? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.